Hello, I'm Kevin Miller, and I'm here today to take you through the first half of 2024, talk about some elements with regard to the indexes in general, the performance of the bond and stock indexes, look at the economy and the markets in general, talk about consumer status, whether the consumer's in a good spot or kind of a tenuous place, recession, volatility potential, how the funds have performed, talk about global currency competition, and then our outlook. So if we start out by looking at the index performance, you'll see this later in the presentation, but you can see these benchmarks or indexes. We have one for money market. We have the Bloomberg US Aggregate Bond Index for bonds. We have two for domestic large cap stocks, the Dow Jones Industrial Average and the S&P 500. We use the Russell 2000 for domestic small to mid cap stocks, and then we use the MSCI EAFE index. EAFE stands for Europe, Asia, and Far East. These are the most common used indexes for these asset classes. And the reason we use two for domestic large cap is because some people follow the Dow and some people follow the S&P. And it's just kind of interesting to see how different their performance have been, especially on a year to date or even the last 3 months ending June 30th. So across the top, you'll see the 3-month returns year to date, 1, 3, 5, and 10-year returns. And then the far last 3 columns on the right, this represents volatility or risk. If the number is high, it's more volatile and more risky. If the number is low, it's less volatile and less risky. So you've got, your 1 year, your 3-year, and 5-year standard deviations here. So you can see the most volatile investments are small cap stocks, as represented by the volatility of the Russell small cap index, the Russell 2000 index. The least volatile would be money markets. Now let's go back, and I want to draw your attention to the year-to-date column. You can see that bonds have not performed well. They've, on average, had a loss. The Dow is up about 3.8. The S&P 500 is up about 14. Small caps up about 1, and foreign stock up about 3.5. So you can see that pretty much everything has been up less than 4%, except for the S&P 500. We're going to talk about that because of how concentrated that is here in the next few slides. So if we move into that, we can see that this gray line on the left-hand table here, that represents the total S&P 500's return, which, like we said, year to date was right around 14%. But if you look at just the top 7 stocks, Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla, if you take the returns of just these 7 stocks, you can see year to date, those 7 are up 33%. The other 493 stocks in the S&P 500 is the blue line, and that's only up 5% year to date. So basically, what we're saying is this is a very concentrated market right now, very concentrated index where 7 stocks are really driving the return. And you can see that over here to the right when it says weight of the top 10 stocks, it's at 37%. I mean, not only is that a big number, but then go back to the mid 1990s, you can see there's never been a point in time since the mid 90s where the percentage of market cap has been this high, highly condensed and concentrated within just 10 stocks. So that what the concern there is if 1 or 2 of these or 3 of these stocks all of a sudden have bad reports, you could see this market turn around real quick. And that's kind of what we experienced in the first part of August, where we saw that Google was declared to be a monopoly. So eventually I would speculate that they're going to probably have to break that up a little bit into smaller companies, kind of like what they did with Bell Telephone. And then also NVIDIA, chip maker, they had an issue with one of their chips, so they had to push back the production of that, the delivery of the chip by at least 90 days. So when you have 2 of the 7 come out with some negative news, it ends up impacting the market. And if these other 493 aren't performing similar to how these 7 are performing, the market can drop a long ways before these other 493 can help support it. Actually, I just looked before I did this, and there's over 190, I think exactly 193 of the S&P 500 stocks year to date have posted losses as through June 30th of 2024. So concentration, again, I'm just going to keep focusing on that a little bit. It's been at least 60 years since we've seen the concentration this extreme. Back in 1964, there were 5 stocks that made up over 27% of the S&P 500's performance, which would have been AT&T, General Motors, Exxon, IBM, and Texaco. As of the end of June 2024, the top 5 stocks, Microsoft, Apple, NVIDIA, Alphabet's also known as Google, and Amazon, they make over 20, almost 29, 28.99%. So this concentration is a very rare thing, especially when you get to these levels. Typically people invest in the S&P 500 for diversification. They're not getting that right now. Basically, it's being driven, like we pointed out, by 7 stocks. If you look at these magnificent 7, from their peak until August 5th, they lost over $2.3 trillion in market cap. Remember, there was a day where the Dow was down over 1,000 points. Again, that's what happens when the breadth of the market is not good, meaning that there aren't enough other stocks there to support the performance of the leaders when some of the leaders have a pullback. And so typically when you see this much concentration, you're going to see an elevated level of volatility. And again, that's what we've seen here in early August. Goldman Sachs has their bull and bear indicator. When you can see that when the indicator gets below the green line, you'll typically see a blue bar shortly thereafter, representing a recession. Okay. When it gets to a red line, you can see above a red line, above the 70th percentile, you can see that a pullback generally follows. I mean, I can't say it always does, because there's always going to be that one time where it may not. But we anticipate that we will see that pullback. And that's why we're just being cautious right now, because we think there's going to be a better time to buy in the near future. This represents the Federal Reserve's interest rates. This is important because if the Federal Reserve raises interest rates, it makes the cost of buying a house or buying a car or buying anything more expensive. And anyone who has credit card debt, it drives up the cost for carrying that debt. You can see that historically, there have been periods where the interest rate from the Federal Reserve has just gone down very suddenly, like from early 2000s to like 2002, and then 07, 08 down to 2000, early 2009. And then you can see it picked up with, and that was the housing bubble. The first one was the tech wreck. And then you can see here where it stair-stepped up, and then we had COVID and it dropped. And then in 2021, you could see the Fed in 2022, the Fed started raising interest rates, and they've raised them all the way to almost 5.5%, which is higher than it's been since the turn of the millennium. Now you can see the blue and green dots coming down. That's what the market expects the Fed will do. And that's what the Federal Reserve Chairman feel that they will do, is that they will be lowering these rates. Last December, Federal Reserve Chairman Powell came out and said they're going to lower rates 3 times in 2024. We haven't seen that yet. No one really, quite candidly, I didn't believe him. However, now with the sudden pullback that we've seen in August of this year, there's speculation that the Fed might actually start lowering in September, and they could come out with a lowering of 0.5%. Generally speaking, when interest rates go down, bonds perform very well. So why would the Fed drop interest rates so fast like we've seen here historically? Well, it's because something was happening in the stock market. In 2000 to 2002, the S&P 500 went down almost 50%. From 07 to 09, it went down almost a little over 50%. During COVID, in a very short period of time, it dropped 34%. We saw it drop in 2022 by 25%, but the Fed just kept raising through that. And it's very, very seldom do you see that happen, but it can happen. And so are we anticipating that the market's going to pull back, and that's going to be the reason why the Fed feels, oh, we gotta drop rates and do what we did in these three previous periods? We're not 100% sure, but it could be an early indicator that an adjustment needs to be made because of what they anticipate the markets are going to do. Let's talk about the consumer. We are a consumer-driven economy where the consumer generates, 65 to 70% of our energy. And if the consumer isn't feeling good, then we're going to start feeling it in our economy. Consumer confidence, the average is represented by this blue dot going across here. You can see that, in the past, the gray bars again represent recessions. And generally a recession follows right around when there's been a big pullback in consumer confidence. And you can see some of these dips here. And we hit a bottom in June of 2022. We've come back up, the green dot here in June of 2024, but we're still below the historical average. So the consumer's feeling better, but they're not exceedingly strong right now in with regard to their confidence. One of the reasons is, yes, their paycheck has gone up since January 2021. The average paycheck is 14% higher, but it buys almost 4% less. So if you got 14% more and you're still buying 4% less, you can afford 4% less, that would indicate that during that period of time, we've had about an 18% increase in inflation. And that's kind of what you're seeing here, is the net buying power of the consumer has not kept pace with inflation. Regarding jobs, they get the jobs reports coming out every month, and it's kind of hard to realize whether they're talking about full-time or part-time jobs. They just talk about jobs, right? Oh, we added the X number of jobs this year. Well, since 2023, the kind of jobs that have been getting added is important to denote, because is it just a seasonal, temporary, part-time position, or is it a full-time career building position? And you can see that on a month-by-month basis, the number of part-time jobs that were added, which would be the blue bar, in comparison to the number of full-time jobs that were lost. And that just doesn't promote a real high level of confidence from a consumer when you're seeing all the jobs that are available are part-time and you're not seeing as many full-time jobs available. So what's happened then is people start working second jobs. And you can see, going back to 1994, the number of people working second jobs in the millions is, pretty much towards its highest level. I mean, it peaked here at about 5 million, and it's well above where it's been in the past. And so that's one way people are getting past this increase in inflation is they have to work a second job. Another way that they're trying to maintain their standard of living is they're using their credit card more, and they're putting more debt on their credit card, which is really, I just hate to see that happen, because the interest rates on that debt, it could be anywhere from 18 to 20 to 24% a year. So yeah, you can buy something, but the cost of paying that off is so expensive. And you can see here in the green line how high that debt has risen recently, to over 25 billion. And then the blue line, you can see how consumer savings is going down. And so that's trending the wrong direction. And quite honestly, this debt is trending the wrong direction as well. So the consumer probably isn't as healthy as we'd like to see them at this point in time. So let's talk about recession. There are two indicators, quite honestly, that just they just don't seem to ever miss the prediction of a recession. And this is one of them. It's called the real-time Som rule recession indicator. And anytime, so it signals the start of recession when the 3-month moving average of the national unemployment rate, which is identified as U3, rises by a 0.5 percentage point or more relative to the minimum of the 3-month averages for the previous 12 months. A little complicated, confusing to get to, and I'm not going to go into detail and explain it, but right now, as of July of 2024, that sits at 0.53, and that's what this indicates. You can see whenever it's been over 0.5, which is just slightly above this black line, shortly thereafter, we've had a gray bar, and these gray bars represent recessions. So, and right now we're at 0.53. So according to this, which has been highly reliable since the 1960s, I would anticipate we're going to see some level of recession in the not too distant future. Likewise, when you compare the yield you can get on a 10-year treasury to that on a 3-month treasury, when you can get a higher rate of return on your 3-month treasury than your 10-year bond, typically that indicates an inverted yield curve, which is a signal for an impending recession. So anytime this blue line goes below this black line, that's a period where you could get more return on a 3-month bond than a 10-year. And whenever that happens, you can see shortly thereafter, another one of those dreaded gray bars appears. Now, what's really interesting to me is how far this is inverted recently and how long it stayed inverted. Because typically that inversion doesn't stay that long below the black line. So between this and the previous slide, if you were to ask me, just basically looking at two very reliable indicators of a future potential recession, I would have to say, yeah, I think we're going to see a recession in the not too distant future. Now, another thing that happened was our currency went from being backed by gold to being backed by oil. From 1861 to 1970, well, it was 1973, right in that area, 71, 73. Our goal, the element that backed our currency was gold. And so you can see that the volatility in energy was very, very tame. Then in technically is August 9th of 1974, Henry Kissinger created a relationship, an agreement with Saudi Arabia that they would only sell their oil in US dollars. And so that took us off the gold standard. Now our dollar was backed by petro, by the oil of the Saudis and the United Arab Emirates. And as soon as that happened, you can see how our energy prices just started going all over the world, all over the place. Now, what's interesting is that August 9th, 1974, 50-year agreement expired in, excuse me, I said August. In June, it was June 9th of 1974. That expired in June 9th of 2024, the 50-year agreement. So we are now in a transition phase where our money is not as backed by the Saudi oil. And I believe what we're going to see is a transformation back into a gold-backed currency over the next 6 months to, I can't imagine it'll go much more than a year. So, but I just wanted to point out that things were relatively stable, for an extended period of time, over 100 years when we had a gold-backed currency, and when we went to a petrol-backed currency, everything started getting really volatile at that time. So how have we performed? How have the evaluator funds performed? So you can see right here, This would be all of the indexes that we already identified earlier in this slide presentation. You can see the returns. This is all the same as what we went through early on when we identified the indexes and benchmarks. This is the very conservative. The range that you see up here is 0 to 15%. That tells you the minimum and maximum that investment will have in stocks at any time. What isn't in stocks would be in bonds or fixed income. So their equity allocation, which is a stock allocation range, is 0 to 15. Currently, it's at 2%. We are keeping the equity allocation low because we expect some volatility, and then we can buy back in and increase our equity position when we see a pullback in the stock market. You can see the performance of this investment for 3 months, year to date. Remember, 1 year is at 3.67, 3 year, negative 0.26, 5 year, 10 year, and then it's volatility over here. Now, to compare that performance to the benchmarks, what we do is we identify the percentage this investment has in each of these asset classes. It has only 1% in money market, 97% in bonds, collectively 1% in domestic large cap stocks, 0.4 in domestic small to mid cap, and 0.4 in international stocks. As you can see down here, here's those asset classes. Here are the indexes. So if you take that percentage allocation into each index times that index's return, in this case, it's 1 year, which is this column right here. You take those times each other and add it up, the 1 year blended return of this investment, if you would have done this on your own using these indexes on a no cost basis, your return would have been for 1 year minus 0.77. That's pointed out right here. So this gray row shows you what the blended return of these indexes has been using the exact same asset allocation as this fund. So it's a reference point. You can say, well, we were down 0.26 for the last 3 years. That stinks. Well, yeah, but bonds have really not done well. And so if you'd have done the exact same allocation over that period of time, your return would have been -5. So now all of a sudden this doesn't look so bad. Also note that the volatility is for 1 and 3 years is substantially lower. The 5 year is right in line. So this is just the very conservative. Then we go to the conservative, 15 to 30%, meaning at least 15% in stocks, but never more than 30. Currently it has 18. Again, toward the lower end of the range. You can see that the amount we have in bonds has dropped from the previous investment. The amount we have in stocks has picked up. So if you do the same math methodology, you would see that the blended 1 year return as of June 30th was 1.54, which you see right here. So you can see the blended performance, you can see the blended volatility, and compare that to the investments return, which, year to date, 2.6, 1 year, almost 6%, positive for 3 year compared to negative, 5, 10 year, and the volatility for 1 and 3 and is much less, 5 years, just slightly less. Okay. Then you look at the moderate, conservative moderate, excuse me. What you notice right away is there's even a little bit less in bonds, fixed income, and even more in stocks. Again, multiply those percentages times the returns of the indexes. It says a blended 1 year is at 4%. You see that right here. You can compare the performance of the blended indexes over these time frames and volatility to that of the investment, which is right here. So year to date, 378 compared to 0.35. What's interesting to me is that this fund will never have more than 50% in stocks, will always have at least 30%. So the rest of it's in bonds. Currently, it has 34% in stocks. That means it has, 66% in bonds, right? Well, it's 65.2 plus another 0.8 in money market. But you look at its year-to-date return is 3.78. Compare that to the Dow, which is 100% in stocks. It's almost outperformed the Dow Jones on a year-to-date basis with a lot less risk. The Dow's risk is 13 and 16 over 3 and 5 years, where this is, 8, 8.3 and 8.7. So, that's, I'll get into how we accomplish that in a little bit. Here's the moderate, 50 to 70%, always at least 50% in stocks, never more than 70%. This RMS, that stands for risk managed strategy. We're not only trying to generate a positive result, but we're also trying to mitigate volatility, keep our risk low. You can see that this fund has only about 45% in bonds, a lot more relative to the other ones in stocks. You can see that its blended 1-year return on the indexes would have been 668, which you see right here. Compare that to the 1-year return, and you're going to see that it's the 1-year return is very comfortably more than the indexes. But the other thing I'd point out is year to date, 5.5%. Remember from the earlier slides where I showed you that 490, the average return of 493 of the S&P 500 stocks year to date was 5%. So even though this fund has, if you look at it, about 46% in money market and bonds, it's still doing better than than 400, the average of 493 of the S&P 500 stocks on a year-to-date basis. I think that's awesome. Again, the volatility is less. Then you have the growth, which has at least 70% in stocks, never more than 85. So naturally, we'd have much less in bonds and fixed income. Multiply the percentages times the returns. Your 1-year blended would have been 953. That's showing up right here. The investment's actual 1-year return as of June 30th was 13. Year to date, it's actually done better than the average of those 493 stocks in the S&P 500. The volatility is less. It's kind of the same song and dance. And then we look at the aggressive growth. We'll always have at least 85% in stocks, never more than 99, because it's always going to have up to 1% in money market or bonds. You can see currently it's at 88%, which is, again, at the low end of the spectrum. When we see a pullback, we will be increasing this equity allocation. Right now, when we add everything together, we're just not seeing a real strong and long-term growth in the market until we see the underlying funds, underlying investments start picking up comparable to the top 7 that we already identified. The blended return of the indexes would have been 11.71 for 1 year. We're looking at 14.71 for 1 year. That's better than the S&P 500. Obviously, it's better than money market bonds. It's better than small cap stocks, domestic, and it's better than international stocks. It lags the S&P, but again, the S&P is driven primarily by 7 stocks. And when the S&P pulls back at a substantial level, the lack of diversification is going to cause its standard deviation to get higher as well. So how do we do that? Well, this is the E-Valuator software, okay? And basically, there's 4 components. We have the dial setting that we want all the underlying investments in the E-Valuator funds to outperform their peers by 25%. As soon as their performance lags the average of their peers by 10% or more, they're going to ping as replaceable, and we're going to give them 3 months to recover. This is exceedingly demanding. Okay, this is much more demanding than what you typically see with any retirement plans or any individual asset management. We apply these standards to these time frames. So we're looking at short-term performance and longer-term performance. We put more emphasis on longer-term performance than we do short-term. So in this example, 20 plus 18, the 3-year and the 5-year returns influence our analytics by 38%, where 1 month returns only influence the analytics by 6%. Okay, so this, I'm just kind of giving you a behind the scenes look at how we select and determine the investments that we're going to make available or use inside our funds. Now, these two dials create 4 zones. They create the solid dark green keep zone. They create the above average watch zone. They create the below at, which is light green. They create the yellow below average caution zone, and then the red replace zone. You don't see any in replace. So these are the fixed income investments that we use inside our fund. So you could simply type in this, any one of these ticker symbols, and you'd see that these are some of the best performing investments in their respective peer group, whether it's short-term bonds, intermediate-term bonds, long-term, high yield, global bonds, emerging market bonds. That's what the last two here are. So you can see where these bubbles are located. We want them all in the dark green keep, because that tells us they're meeting the standards that I just showed you. If they were in yellow or red, that would mean they're lagging and we would need to replace them. This would be the domestic equity pool. So you'd have your domestic large caps, large caps with value and growth. Then you'd have medium-sized companies, medium-sized stock, which would be value and blend and growth managed. And then you'd have small caps. And you can see again, what we're seeing here is they're all meeting our demand. So when we request that we demand that these investments outperform the average of their peers by 25% or more, that gives us a leg up on the competition. So we're truly using the best of the best. And we typically replace out a fund. Boy, I would say there's probably 1 or 2 that we replace out every quarter, just because we do have those demands set relatively high. You don't see that because it's happening internally, but that's what's driving our returns. And then here you have the foreign and specialty equity. With inflation, you know what it is. We do have like a fund that invests in silver. We have one that invests in gold. We have one that is a commodity driven fund. So that's kind of our inflation play. When we see inflation somewhat mitigate and flatten out, we'll get rid of these and we'll probably get into, you know, something else at that point in time. We do have one fund that's above average. It's dropped from the solid keep zone into above average, but it's starting to trend back up. So we're not going to replace it at this time. So let's talk a little bit about currency competition, because the US dollar, since, we went to, especially since we went to the petrodollar and everyone needed US dollars across the world to buy oil from Saudi Arabia, our dollar was really strong. It was the world's reserve currency. Again, Saudi Arabia did not renew that agreement on June 9th of this year. So currently our dollar technically isn't backed by Saudi Arabia oil. In fact, they're selling their oil to countries throughout the world in the base currency of that country at this point in time. They're not selling it exclusively in US dollars. So I think I may have brought this to your attention in a previous video, but there's a consortium of countries called BRICS: Brazil, Russia, India, China, and South Africa. These entities have created their own international currency for trading purposes, and it's precious metals backed. So the concern is that there's several that have recently joined: Egypt, Ethiopia, Iran, Saudi Arabia, and United Arab Emirates. And as you can see here, the green would be the countries that were the original founders or participants in BRICS. Yellow represents countries that have applied for membership. And then the blue would be countries that show interest. And the concern is that if all of the BRICS that have applied and shown interest actually join, then they would contain over 65% of the global population, over 60% of oil production, 40% of gold production. So it's something we just can't let go unnoticed. All right, the G7, those would be the other developed countries like us, and you can see that our percentage on a global perspective of each of these five elements is not as robust as what the BRICS consortium is. And so that's just something that I think we're going to see work its way out over the next 6 to 18 months. And there's going to be some volatility. And so as a result, we anticipate volatility is going to be higher than normal because indexes are very concentrated. Obviously, we have the global tensions and we have the presidential election coming up. And the thirst for power in our political system seems to amp up. It seems like every term, every election that I've been a part of. We do expect the Federal Reserve will lower interest rates, potentially 0.5% in September, and maybe another lowering depending on what the economic outlook looks like later in the fourth quarter. Housing markets are tough. Mortgage rates remain relatively high. Turnover remains low because homeowners with low mortgage rates aren't willing to move out of there and go into a higher cost housing, basically. So the inventory is down. Building applications are low. So housing would definitely benefit from a drop in interest rates. Right now, we think getting longer in your bond duration is the place to be, because if and or when the Federal Reserve lowers interest rates, your longer duration bonds will perform very well. Okay. From a stock market performance, we expect to be very volatile. We've seen that here in August already. It's going to be influenced by the Federal Reserve's decisions. It's going to be influenced by Iran and Israel, China, Taiwan, Russia, Ukraine. It's going to be influenced by the BRICS. So I think up until and through early November, we're just going to look at buying opportunities. We see a pullback, we're going to take advantage of that. We see a run back up, we're just going to let it run up, and then we're going to wait for the next pullback. And I think that's what you're going to have to do. Not that we want to manage on an ultra short-term basis, but we're in a very unique situation here with what's going on, not only globally, but also domestically. As I pointed out before, NVIDIA had a production delay. Google was declared a monopoly. And then we also see continued expansion of AI. All those things are going to be positive attributes to the outcome of the markets. And there's also going to be some pressure points of challenge. So in essence, we feel things are going to be good. It's just that we're not going all in, raising our equity allocation to the highest level for each of our funds, because we see there's more likelihood that we're going to see a pullback and be able to capitalize on that, as opposed to just consistent incline going forward. Here's the disclaimer. I need to leave this on the screen for a little bit, but thank you very much for taking the time. If you want to look at this in more detail, just stop the recording and go ahead and take time to read the screen that you're looking at. And please feel free to reach out to me and call me with any questions.